My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. And today we want to offer another presentation in our I Want to Be a Trader series. We're going to talk about using diagonals and calendars in challenging market conditions with our friend Karen Smith, an instructor of Options Animal at Options Animal. The I Want to Be a Trader series is designed to help retail investors who want to become better traders. We believe that a better understanding of trading fundamentals would help you. And so today we're going to talk about the more advanced ways to use options, stock options. Now, many experts believe that the most important thing a new trader can do is become educated about the language of trading and basic market concepts by studying everything together: fundamentals, technical analysis, price analysis. We think that will help you become a better trader by determining some of the basic conditions of looking at investments by examining all these core indicators. By studying this together, TradeStation traders can identify stocks that might be better investment choices. So this series of TradeStation online seminars will introduce a wide range of market analysis concepts and trading ideas for you as a novice trader. We think that trading money in a bullish market can be fairly easy. However, a choppy or a sideways market or even a bearish market can be extremely tricky. So in this webinar, Karen Smith will demonstrate how and when to use calendar and diagonal option spreads to help make money. Karen began her own trading career back in the early 1990s using mutual funds as her primary trading vehicle, and she managed her personal portfolios while she acted as the comptroller of a family business. She was successful with her methodology, but she decided that options could afford her greater leverage, and she became interested in that concept. She is very privileged, she's told me, to be part of our presentation series today, and so I can't wait to introduce her to you and offer her as your instructor for the next hour or so. Our presentation here is going to be educational and for educational purposes only. All the symbols and all the trading ideas that we're going to discuss here are for demonstration purposes. They are not recommendations. It's not an offer or a solicitation in any jurisdiction where any TradeStation affiliate's not authorized to do business. Active trading may not be suitable for you because it's not suitable for everyone. Options trading carries a high degree of risk and might not be suitable for all traders either. The characteristics and risks of standardized options disclosure information has been posted in the chat panel for you to read at your convenience. Also in the chat panel, I've included upcoming events in the TradeStation webcast series. We'll talk about some of them in a moment. If you need assistance with your TradeStation platform and you need to customize it or would like to customize it, we have a service that will help you tailor your TradeStation platform to your own unique needs. You can schedule a private 60-minute one-on-one session with a seasoned TradeStation platform expert and pick up some tips and pointers on platform training, trading environment setup, and customization. So schedule your private online session now. Make that online reservation. The I Want to Be a Trader series has some upcoming events. We're already talking about our January dates. December 14th, we'll be talking about understanding volatility for options traders. That's tomorrow. We'll also be moving into the January events. On January 10th, we'll talk about why your stocks need the safety of options. And on January 11th, becoming a Fibonacci pinball wizard. Which brings me to our presenter today, Karen Smith of Options Animal. And Karen, welcome to TradeStation.
Well, thank you so much for having me. It's truly a pleasure to be here. And again, as I said earlier, Dawn, to work with you once again. Hello, good afternoon, everyone. I hope you had a wonderful day in the market today. The Santa Claus rally continues. Santa really is delivering the goods this year, I have to say. So it is my pleasure to be here and to discuss some fantastic trades for this particular market environment in terms of our calendars and our diagonals. And as was already said, obviously, the purpose of our time together today is for education. Nothing that is said here should be considered to be any sort of investment advice, as options, of course, do involve risk. Oh, I need to up the volume? Well, let's see what we can do here, my friends. Let's take a look and see if this will be a little bit better for you in terms of that sound. As I was saying, options do involve risk. They aren't suitable for all investors, and all rights, risks, and obligations of options instruments should be fully understood before entering any trade. And the sound is better. Excellent. Well, thank you for the feedback, everyone. I appreciate that as well. I have some specific goals in mind for our time together this afternoon. Here at Options Animal, we are an educational organization dedicated to teaching individuals how to become consistently profitable in the markets across time. And there are many tools and skills involved in that endeavor. In the next hour, it is my goal to show you how we at Options Animal achieve this. You are going to see what I like to call peeks under the hood today in terms of actual slides from our curriculum about these particular trades, calendars, and diagonals, some of the favorites amongst our Options Animal community. One of the things that we teach in detail within our curriculum is a 6-step process. We call it our lather, rinse, repeat process for trading. If I have time, I'll take you to our website and show you some information about that as well today. Now, before I get into all of this great content, what I'd like to do first is simply ask just a few quick questions. If you don't mind going right back to that chat box that you so kindly let me know my volume was too low, and answer the following for me, if you don't mind. First of all, how many of you have familiarity with options in particular? I know some of you are day traders, some of you are utilizing futures, all different sorts of instruments, right? I just want to get a sense of if you have experience and if you don't. If you don't have experience with options, that's perfectly fine as well. If you could just let me know. And I do see that quite a few of you do have experience. Fantastic. Love to see that. Let me ask you this. How many of you have experience with these particular trades, our calendars and diagonals in particular? Okay. Not all trades work ideally in all market environments. I love what was said earlier about the fact that it's relatively easy to make money in a bullish scenario. We have all sorts of things available, but we know that the markets are not always bullish. There are times when the markets are rather stagnant, sideways. We had that for quite a period of time, both in all the way from 2014 through part of this year. There are times when markets are bearish as well. So we want to have those tools and skills to trade all of these different market environments. And I can see we're a little bit split in terms of our experience with this trade or not. Okay, some calendars, no diagonals, Terry. Excellent. Well, what I'm going to do today is show you what these trades are about, what it is that we're utilizing here for success in these particular trade structures, okay? And so, without further ado, let's get into some of this information as we speak. So, our agenda today will be to talk about the two sides of the option chain, the call calendar as well as the put calendar. We'll take it a step further, I like to call it, when we begin to discuss the idea of diagonals as well. At the end of our time together, we do have a special offer regarding becoming a member with us here at our Options Animal community. Keep in mind, I'm very proud to say that we are a preferred educational vendor for TradeStation clients. We have quite a few TradeStation clients that are part of our community. Okay, and I'll tell you a little bit about my journey and story as we go through this fantastic content, how I found my way, if you will, as a trader to Options Animal. Let's get started first with our call calendar. Okay, what we are doing is combining, as we do in spread trades, multiple options together at the same time. And the reason that we do this is because it gives us the ability to control risk while also allowing for exceptional, even phenomenal, in some cases, returns in our trading. So with our call calendar, we're combining both a long call and a short call. These instruments are going to be placed at an identical shared strike price, but will have a difference in terms of their time. We do this because we want to take advantage of the fact that short-term options are decaying very, very quickly. Now, this is a graph for theta or time decay. This graph is particular or specific to options that are close to where an equity is trading, or as some of you are very familiar with, the at the money or near the money position on the option chain. And so the thing that you notice with this time decay graph is that it isn't linear. It isn't a 45-degree line. We actually have different rates of theta decay. So we want to take advantage of this by placing our long call with more time than our short call, which will be in a shorter term expiration series. If we take our long call and place it, let's say here, with about 90 days or so of time value to that call, the thing that you notice is, of course, as all long options do, it's going to experience time decay. But by positioning a short call with it in the same trade, we know that our short call is going to have a much greater degree of time decay. Not only will this time decay offset that of my long call, but it will actually provide profitability in this particular trade. As an instructor at Options Animal, a question that I see frequently is there a way for us to use these short-term options in somewhat of a safer manner? Some of you may have some good success with the weeklies, let's say. Some of you may not. There's a lot of different components that go into trading short-term options. This is a way for you to position to take advantage, especially for those of you who like to sell premium. I'm someone who does like to sell premium for profitability in a lot of trades that I construct. So for those of you who like to do that and who like to be active traders, this is a way for you to take advantage of the fact that we do have these short-term options that can provide us consistent profitability in our trading. Okay, so let's take a look at this call calendar. What we're ideally looking for, the easiest maintenance, going to what we call at Options Animal our primary exit, our profit potential quickly, is a slightly bullish to stagnant trend scenario for this particular trade. Our long call is, as I said, the primary instrument in this trade, the major money maker, if you will. The short call is our risk limiting instrument in our trade. When we put these options together, we create a profit and loss graph that looks like this. And the thing that you see in this profit and loss graph is that this is actually some degree of a range bound trade scenario. If the equity remains inside and above our break-even point and inside this particular graph, we're going to have some degree of profit. Absolute highest profit comes right here at the tip top, where the options share that strike price, both our long call and our short call. So we combine our out-of-the-money long-term long call with 3 months or more of time and a near-term short call, again, at that shared same strike price. The maximum risk in this trade is the debit. Most we could lose, worst case scenario, is the debit that we pay when we start the trade. Now, again, the maximum potential reward is if the equity actually on options expiration traveled to our shared strike price with our calls. We'll show you this specifically in just a moment. If managed over a longer time frame, which is often how I do manage my calendars and diagonals, the maximum reward is theoretically unlimited. In other words, we can continue to sell calls against that long call across time, continuing for profitability. Let's take a look at an example. As I said, not all trades are for all equities nor all market environments. I mean, we are screaming to the upside right now. So right now, in certain situations, these could be challenging. However, I don't know what your expectation for the market is. My expectation is once the Santa Claus rally is over, that things will probably, at the very least, settle out to some extent, okay? Or we will not be marching to the upside to quite a great degree. It might be a very interesting opportunity at that point in time when we have some consolidation to place these sorts of trades. So this is a perfect chart for what we're looking for ideally in the setup of this trade. We have this equity XYZ, and as you see, it has a bullish bias to it, but it has also been in a range for a while. This is a great technical setup for this type of trade. So what we're going to do here is establish our call calendar with a long and short call strike at 1:30. Yes, this is a 6-month daily chart, Tony, to answer that question. Yes, okay? So let's take a look at the setup for our trade. Our expectation in setting this calendar slightly out of the money is that XYZ is going to, over the next 9 days, because that is the duration of our short call in this example, over the next 9 days, the equity is going to travel toward our strike at 1:30, okay? So here's the setup for this particular trade. We buy to open the 191-day strike 130 long call at the ask of $5.55. We then sell the 9-day strike 130 short call at the bid of 44 cents. And yes, we will be following with diagonals in just a bit, Scott. That's correct. For a total debit, total risk in the trade of $5.11, okay, per share. Primary exit, the short call expires, and we may be able at that point to close our strike 130 long call for profitability. Secondary exit would be to close at a % net loss or adjust to the resultant trend. Now let me say something about this, because as I said, I really want to illustrate to you how we are different in terms of the education that we offer at Options Animal. Well, the first part is right here. The idea that you can make adjustments to trades when things do not go the way that you expected them to go in your trading. At Options Animal, over the past 7.5 years, we have been closing 91% of our trades successfully. I ask you to compare that to your own statistics in your trading. Part of that success, as a matter of fact, a key component of that success is in the ability, the knowledge, the specifics about how to make adjustments when trades do not go as we anticipate they will go. We teach over 20 different spread trades. You're seeing, of course, several of them today, and every one of those trades has its own methodology that we teach for adjustments. Okay, so I wanted to be sure that you knew that. In a stagnant trend, what might our long call be worth when the short call expires? When I am evaluating opportunities for these sorts of trades, okay, the first thing I do is I say, all right, let's assume for a moment that during the duration of my short option, my equity is in fact stagnant. Basically, it finishes exactly where we started. Would I have a profit in that scenario? That's the first step, okay? Because if I can be profitable in the stagnant trend, as well as some degree of bullishness, that opens up probability of success for this trade. And I like to take trades where I have a higher probability of success. So what we do is we walk through the calculations. How do you look at this and say, okay, well, what might my trade be worth if in fact XYZ remains at $120 and $127 rather and 70 cents? Well, I take the bid value, the price at which I sell the option back to the marketplace. I take that value for the long call and adjust it for theta decay. Because if my equity is stagnant, then I get to keep all of this 44 cents of credit per share I take in on my short call. It will in fact expire worthless. So now what I have to do is theta decay my long option. Well, I will be in this trade for 9 days. That is, again, when the short call expires. And my long call is losing 0.0185 cents per day for a total loss, theoretically, of 17 cents on this call. So now what I do is I take the bid value, again, the value at which I sell the option back to the market, subtract my theta decay, and this leaves me with $5.28. This is the likely credit I could receive selling this call back to the market. So would I be profitable in this stagnant scenario? Yes, I would. I would have 17 cents per share of profit for a 3.3% return in 9 days' time. Okay. Tony, a question. Do we use stops based on the underlying? We do not use stops. Okay, there's a lot of issues when it comes to utilizing stops, and we could certainly, I can give you my email and I can certainly email you about that. But what we would rather do is use our combination of technical indicators to indicate when trend change is happening, and then we make proactive adjustments to our trade. That's a really good question, Tony. I appreciate that. Now here's where things get really interesting with this trade, and that is if we pick the right strike prices for this trade, and in fact the equity does travel to this strike 130. What happens now in terms of profitability for our trade? Because this 17 cents per share of profit was strictly based on theta decay, okay, or the theta decay, particularly from our short call. Well, now what I get to do is I get to add in the Greeks of delta and gamma to the trade. Some of you, I'm sure, have studied the Greeks at some point in time. They help you understand how trades function, how premium changes, because obviously premium change is what this game is all about for profitability. So we take our theta adjusted value and then adjust it to account for the movement of the underlying equity. In other words, our long call is going to gain value because the equity does in fact move to the upside. Our long call has a delta of 0.4780 cents per share. If our stock moves up $2.30 to our strike 130 call, well, what this means is that my call will gain $1.09 of premium. When I add that back to my theta decayed value, you notice that I could theoretically sell this call back to the market for $6.37. So what is the profit in this scenario? Well, take a look, everyone. $1.26 per share. When I take that and divide it by the risk I took in the trade, 24.6% return in 9 days' time. And that's why I say when you find the right scenario for this kind of trade, your return can be exceptional in these instances. Okay, 24%. If you annualize that, it's going to literally be thousands of percent in that scenario. Now, I want to show you, let me ask you this, another question really quickly. How many of you have studied the Greeks, and how many of you have not? If you have not had experience with the Greeks, that's perfectly fine, but I'd just like to get a sense of your experience level with the Greeks, because the reason that the Greeks are so important is they tell you how to establish expectation. They tell you how to line up the right trades at the right time for your expectation in the marketplace. Let me give you an example, if I may. Okay, I said that the markets are very bullish, as we've seen, Santa Claus rally. So one of the things that I've done to take advantage of that is I've had long calls on the SPY. The SPY is the ETF for the S&P 500. I'm sure some of you trade it as well. I can, at any point in time, turn that into this trade. I could turn those calls into directional calls, into a calendar or a diagonal if I decided to short calls against it. Now, because the market is so bullish and running so much, I'm not doing that at this particular point in time. We may have a change come tomorrow. We've got Janet again, and we've got the Fed and the idea that they're very likely going to raise rates tomorrow. So we could see where, at the very least, the Santa Claus rally begins to stall. And it might be a time for me to, quote unquote, make an adjustment to those calls if I choose not to just take my profits in them at this point and turn them into this sort of trade, continue to work that profit continuum on the trade. Okay, so what I walk through now is the Greeks, because the Greeks help us to understand what is my trade expectation. What should my trade expectation be based on how this trade is likely to perform given these different scenarios in the marketplace. This is a beautiful chart example for this sort of trade. Okay, you're looking for that nice gradual uptrend, right? Lower left to upper right. In this particular chart, we don't have a lot of gaps. Okay, we don't have a lot of really large movements. All the sorts of things that can make this particular sort of trade more challenging. So this is an ideal chart setup for this trade. So XYZ is trading at $62.22. We buy to open the 122-day strike 65 long call at the ask of 81 cents. We sell the 31-day strike 65 short call, taking in 15 cents of credit at the bid for a total debit of 66 cents. And there's that familiar looking profit and loss graph with the peak right here at that shared strike at 65. So what do the Greeks look like? Okay. When it comes to understanding the Greeks, there are some very important conventions. I realize that many of you use the fantastic TradeStation platform, and you go in and you construct your various trades, and all of these sorts of things are calculated for you, right? You can use your probability analyzers and things of this kind to actually get this information. But it's really critical that you truly understand what those analyzers are showing you in terms of how that trade is going to perform. And that's why we go into lots of detail inside our curriculum. We want our students to have that thorough understanding because it helps in all phases of your trading process, from the selection of the equity to trade, the type of trade to place, the strike prices and time frames, the management of the trade to profitability. All of those pieces are impacted by an understanding of these parameters right here, the Greeks. So in terms of establishing what we call our net position Greeks, in other words, the trade as a whole, how it's going to perform, we take our primary instrument, which is our long call, and the Greeks are exactly what you see on your chain. Many of you have experience already in terms of utilizing options, so you know that when you sell an option, you reverse the signs of the Greeks, as your option chains are always presented from the standpoint of purchasing your option. Okay, so then it's a simple matter of doing the math, I like to say, in terms of arriving at our Greek values. So let's start right here with delta. Okay, delta is positive, $16.61. What does that mean exactly? Well, what it means is that when my equity itself goes up $1, my call calendar is going to make $16.61 on that first dollar move to the upside. Okay? Conversely, it also means if I position this trade and the next day the equity falls $1, my call calendar will lose on that particular day $16.61. Now, delta is not fixed. Delta actually changes, and how it changes is identified or quantified, I guess would be a better word here, by gamma. Call calendars, put calendars, and diagonals to some extent, although not as much as the calendar version. These are what I call sensitive trades. There are trades where too much of a good thing is actually a problem, meaning that for our call calendar, too much bullishness can actually be a problem for our trade. And it has to do with the fact that we're working with options in different time frames. This negative gamma is really what identifies the fact that too much bullishness can get our trade into trouble, because every dollar that my equity goes up, okay, I make money, but my delta, because of the negative gamma, my delta will actually get a little bit smaller and a little bit smaller and a little bit smaller. This is a trade designed for a little bit of bullish movement. This isn't a trade that's designed for big gaps and huge moves to the upside. If that does start to happen, we can make adjustments to the trade. But in terms of our Greeks, our delta gets smaller and smaller, and believe it or not, with enough bullishness, you could actually create a negative delta. And a negative delta means we now have a trade that needs negativity or bearishness to be brought back to profitability. That can obviously be an issue if you have a very strong bullish trend in place. Okay, so it's important that we understand gamma and how it changes our delta. John's got a good question. How did we get the $16.61 delta? Okay, very quickly, I'm going to give you the quick and easy method, John. Remember that everything you see on an option chain is presented per share. Options control 100 shares. So you move your decimal point. It's hard to do. This is kind of a thick little marker here, but you move your decimal point 2 places to the right. You put a dollar sign here, okay? And then the other part of this is you do the math. Remember that the long call has a positive $30.80 of delta. The short call actually has a negative $14.19 of delta. So when we add those two together, that is how we arrive at our positive $16.61. I hope that made sense, John. And that's what we do with all of these Greeks, by the way. Oh, my pleasure. Absolutely. Okay, theta. Love this. I love to make money every day with the passage of time. It's a fantastic thing. So think of that. This is a trade where we actually have a long instrument, a long call, that typically we are battling time with long calls, right? We're battling theta decay. But because we've added this short call to it, we get the benefit of the bullish movement to some extent, but we also get a positive theta out of the trade. We have to love that. And then Vega. Oh boy. I could talk for a long time about Vega. Vega, implied volatility. Okay, that's Vega's the Greek for that. It's a big impact on these trades. It's a big impact on all your trades, actually, but it's a big impact here. $8.58. Now, what does that mean? And this is one of the keys when it comes to really understanding these trades and finding the opportune moments. At Options Animal, we want to teach you these trades, but we want to teach you how to find the opportune moments for your trades, okay? So this is a Vega positive trade, which means that it benefits from an increase in implied volatility. Implied volatility, we teach an entire class specific to implied volatility at Options Animal. That's how important this concept is, okay? To simplify for purpose of time, this is a ballooning effect when it comes to premium. When implied volatility goes up, premiums get larger. When implied volatility goes down, just like a balloon that gets deflated, premiums get smaller. With this trade, we are creating a spread trade that benefits pretty significantly to the increase in implied volatility, which is to say, if we find some opportune moments where we have lower levels of implied volatility with our options, and we position a trade like this, it's one of the ways we can take advantage of an increase in implied volatility that we expect, okay? Tony, you're asking some good questions. Is there a minimum delta to consider with the trade and also with Vega? In terms of the delta, with a calendar, in particular a calendar with the shared strike price, we'll get into diagonals in a few moments, but with the calendar in particular, shared strike, you're going to have a relatively small delta. And the reason for that, of course, is that we really are taking advantage of Vega, increases with implied volatility, and also our theta decay. One of the things we can do to get a larger delta, in other words, benefit from more equity movement, is to take this trade and change it just a little bit. And that's what we do with the diagonal. And I will cover that with you today. Okay? So excellent questions as well. Rho is positive, and this has to do with changes in the risk-free interest rate, but it's of little consequence to the trade. So I'm just going to run through this because I'm watching our time and I really want to get to the put side, okay? This is something that I actually placed myself this week on the spot. Now, I just told you that I'm bullish. I just told you that I've had long calls on the SPY, right? Trading the SPY bullishly, which makes some sense. Look at the chart, right? In the Santa Claus rally. But something has happened as the markets have rallied. And that is that we've started to see, with the exception of the last several days, we've started to see implied volatility. The VIX, by the way, represents implied volatility for the S&P 500. We have seen implied volatility lower again. And I just mentioned to you that these are trades to take advantage of an expected increase, potential increase in implied volatility. This is where the put calendar, the put side of this trade, can really shine. Because those of you with experience know when we do get some volatility in the market, particularly if we get some sort of correction, profit taking, a little bit of sell-off, what happens to the VIX, right? What happens to implied volatility? It typically goes up. And that is of benefit here, in particular on our put calendar side of things. So what we're doing is we are going to use our long and short puts. We're going to place these options again at that shared strike price, just like on the call side. Once again, we are taking advantage of the different rates of theta decay. All of this is the same. It's just now we're expecting a slow-moving bearish situation as opposed to bullish. That is why we would choose the put calendar instead of the call calendar. So again, we go out further in time with our long put and a shorter term short put, taking advantage of their different rates of theta decay. As you see, there's that profit and loss graph, again with the maximum profit being at that shared strike price for this particular trade. We're going out of the money with our long put, 3 months or more of time, near-term short put at the shared strike price. Maximum risk is the debit in this trade. Maximum potential reward is at the strike of the options if you manage it just for that initial lifetime of your short put. But again, we can manage this over. And a lot of times, my friends, I do manage these over multiple time frames. Not always. Sometimes I will just take it to the expiration of my short option. It depends on what my expectation is, what the return is I'm looking for in the trade. But oftentimes I will work these for longer, particularly if I've got a trend at hand that I can work with. These were great trades, by the way. When the markets were having such difficulty breaking out, you know, we kind of had the S&P sit around in a range an awful lot, you know, particularly last year, 2015, and then even part of this year. Phenomenal trade opportunities, okay, for this sort of trade, both the call and the put side at times. So what are we looking for? Well, we're looking for an equity that is having some pullback, particularly in this bullish market environment. You know, there will come a point in time, obviously, when the markets will change, when we'll actually have a true bearish market environment on our hands, and we'll probably go to the put side a lot more frequently at that time than we do at present. But at the very least, what we're looking for in this sort of market is either an equity that does have that longer-term bearish trend or a pullback opportunity, a way to trade pullback opportunities in a bullish market environment. So here, in this example, we have some chart indicators that we teach in the first level of our curriculum that have flashed bearishness in the short term. So what we want to do for our trade is we want to set this with XYZ trading at $64 a share. As we start the trade, we're going to establish our put calendar at the 62.50. So one strike out of the money at the 62.50 strike. So we buy the longer term long put, paying the debit of $2.47, and then we sell the shorter term short put, getting a credit of 31 cents. Now, one of the things that I look for when it comes to opportunities with these trades, and again, may not find it all the time, but when you do, spotting that key moment, right, the opportune moment, I like to call it, forgive me, is when I find higher levels of implied volatility in the shorter term options as compared to the longer term options. In particular, if my expectation is that during the course of this shorter term put, implied volatility is likely to come back in again. Perfect example, things like ahead of Brexit, ahead of the election, things of this sort, right? When there's uncertainty present in the market, that's when levels of implied volatility increase. Those can present some really interesting opportunities for various trades, okay? So let's take a look at this particular example. Our total debit in this trade, $2.16. Maximum reward, potentially high. Again, the reason we say it that way is because it depends on how we decide to maintain this trade. If we do another short put at the end of 22 days or not, those sorts of things, okay? Primary exit, allow the short put to expire worthless, close that long put for profitability. Secondary exits, we teach multiple secondary exits for all of our trades. Because the truth of the matter is when we get into a trade, any trade, We don't know what's coming to the right of the chart. And therefore, there are various reasons, various trend developments that may come along and cause our trade to need adjustment, right? With this particular trade, if we have too much bullishness, that won't work for this trade. If we have too much bearishness, that can be a problem for this trade as well. So we have multiple adjustments that we can utilize for this sort of trade depending upon what actually occurs. So you notice here in the example of a very bearish scenario, we could roll that short put out in time into a lower strike price, continuing to follow the trend that the equity is having to the downside as it develops. Okay, and there are others that we do teach as well for this particular trade. Now, what is the expected rate of return for this trade? Again, if it's stagnant, our short put expires, so our long put is the piece of the trade that is remaining. What is it likely to be worth? Well, we're going to do just like we did with the call, and we're going to theta decay our put for 22 days. That's the lifetime of our short put, right? So how do we calculate that? Well, we take our theta decay per day, 0.0077 cents. And see, here's the advantage. When you go this far out in time, you are not having a great degree of theta decay that you are battling. That's the wonderful thing here. It gives you time to work with the trade. Okay? So, notice for 22 days, we're only losing 17 cents to theta decay in this particular example. So we take the bid value, okay, again, the value at which we sell the option back to the market, and subtract our theta decay. $2.25 would be the theoretical credit we could get on our put. The cost of the trade, the debit originally of the trade was $2.16. So yes, we are slightly profitable in the stagnant scenario. Why are we doing this trade? Because we really do expect that the equity is going to be slightly bearish or fall toward our shared strike at 62.50. I see some great questions. If you'll hang tight, gentlemen, I promise I will get to those. They're really nice questions. So we know the theta effect. Now let's talk about the benefit of equity movement, in this case, to the downside or the bearish side. Well, we get to add our delta effect to the trade, right? The long put gains 0.3856 cents per share for every dollar that this equity falls. Okay, so if it goes from $64 down to $62.50, that means our put is going to gain 58 cents of premium. So we get to add this to our theta adjusted value for a total potential credit of $2.83 when we sell this put back to the market. So what is our gain now? Well, our debit originally $2.16, 67 cents of profit. That's a 31% return. And so you can see from the potential returns on these trades why they can be so advantageous in certain market conditions, right? You know, I know that for some of us, when we don't thoroughly understand options, I mean, this was my journey. I was self-taught with options. The year was 2008. That might ring a bell to some of you, 2008, the last great bear market that we experienced. You know, Dawn told you a little bit about my history, and I don't want to go into all of that, but let's suffice it to say that one of the things I was drawn to with options was the fact that I could trade multiple trend scenarios. I didn't have to rely on the bullish trend for profitability. I also, of course, was drawn to the sorts of profits that were showing you the potential for those sorts of profits, as you can see here. Now, I had a lot of missing pieces in my self-taught journey in 2008 that actually caused me, like so many individuals, unfortunately maybe some of you as well, to lose money in that aggressive bear market. That's when I searched for education and how I found Options Animal myself as a student in April of 2009. So that's when I started. I did not understand everything that I walk you through today. in terms of the sort of trades to place at various times, and how things like changes of levels of implied volatility would be very impactful to all of the different trades that I was placing. So for example, Richard, you're asking, can you put on a calendar after you are already long the option? So as I mentioned earlier, one of the things that you can do is, if you are working with any sort of directional options, is if your equity starts to stagnate, it starts to be range bound, which we all know can be frustrating, particularly if you're just a buy and hold sort of investor, that type of thing. A stagnant scenario doesn't work well for that. It also doesn't work well for your directional options because they're experiencing theta decay. You need the delta, you need the gamma, you need the increase in implied volatility for profit. So yes, you can go into and again back out of, even at times, the calendar, or as I'm about to show, the diagonal as well. Absolutely, yes. And Tony, your question, what is the advantage of the calendar versus a straight vertical? The straight vertical, so for example, on this put side, if we're talking about buying a put vertical for a bearish expectation, right? That trade will perform better if you get a more aggressive bearish trend than will this trade. This trade works ideally in the slow moving bearish to stagnant scenario. The put vertical, if you're buying a put vertical, you're looking for aggressive bearish movement, particularly if it's an out of the money put vertical. Now, if you're selling a put vertical, that's a whole different story. Okay, and those, of course, are all trades that we teach inside our curriculum. Okay. In terms of the Greeks, we'll go through this quickly. I'm trying to mind our time, but what I want to do here is show you, so we'll just populate this and kind of run through these, what the put calendar looks like. Okay, and so the first thing you notice is negative delta. Now that should make sense, right? Because in this particular example, what we're talking about is looking for a slightly bearish trend, or a slow moving bearish trend, right? So we have a delta of a negative $13.22. If we had one at the money long put by itself, we bought a long put, expectation bearishness, okay? That long put, again, roughly, is going to have a delta of a negative $50, okay? Somewhere near a negative $50 for the at the money long put. Our trade, a negative $13. So we are not looking for, again, that same degree of aggressive bearishness, but rather slower moving bearishness. Okay? Gamma, negative, which I already explained on the call side, meaning too much bearishness too quickly can actually become a problem for this trade. And the reason for that is because of our time differential between our two options. So, you know, when you think of equities that like to move a lot and quickly, those are not always the ideal candidates for this particular trade. So I'm trading Amazon, I'm trading Google, Apple, some of the techs that haven't been participating so far in the market. I'm not doing this trade for those, right? Did you see what happened today with Amazon and Google and the techs? They finally participated very strongly. I'm using other trades to take advantage of that sort of movement. But at the same time, I have this sort of trade on the spot, because my expectation is that we might get into sort of a topping and just kind of roll over potentially for a period of time. Nothing ultra aggressive, just kind of a slow rolling over. So the great thing about this is when you understand this, you can position your portfolio much like a hedge fund manager does, right? Where there are certain equities, certain areas where you may be very bullish, other equities where you may hedge with a trade like this. You put all of these pieces together. This is what we teach you to do inside the curriculum. Okay, and again, my goal here is to show you how thorough and full circle we are at Options Animal. Theta. Theta is positive, okay, making money with the passage of time because of our short puts. Theta. Vega, big one. And, you know, it's interesting. This put calendar that I did, it's actually a diagonal, that I did, I put on last week, okay? And we had lower levels, slightly lower levels on the VIX, lower levels of implied volatility. And so what's happened? Yesterday was kind of flat. Today was a huge screaming day to the upside, right? So you would think that a put diagonal that I placed last week would be losing money. I'm not. Okay, and that has to do with this right here. One of the reasons I'm in this trade right now, Vega, because the VIX went up today. Implied volatility is up, which is indicative of the fact that we're participating, money is participating in this move to the upside, but they're hedging at the very same time. Because let's face it, we've had an awful lot of bullishness in a very quick amount of time. It wouldn't take much like something surprising from the Fed or the ECB or things of this sort for the market to at the very least take a pause or even have some profit taking come to play. Okay? All right, rho is slightly negative but of little consequence. And Terry, you're saying implied volatility higher on the short leg. That's ideal. Like I said, if you can find those scenarios, that can be very helpful to you because remember, you're selling that premium. You're selling that higher level of implied volatility on your short option. You're getting a juicier credit, is what I like to say with that, okay, if that's the case. In particular, if implied volatility goes up, by the way, this Vega value right here of $10.15 of benefit, if implied volatility goes up, that is being driven by your long option out in time. Look at how much bigger its Vega value is as compared to your short option. Okay, and that's what really can drive some good profitability in this trade. Okay. This I'm just going to run through quickly. I do want to get to diagonals with you, but what we're showing here is an understanding of why too much of a good thing, too much trend, in other words, in the direction of your trade is actually a problem. Because there's a lot of trades that we teach you where that isn't a problem. The more, the better. Long options, I call it pedal to the metal, baby, right? Let's go. You know, we can't have too much bullishness for our long calls or bearishness for our long puts. There are other spread trades that work the same way, where, you know, the faster the equity goes on the move in certain directions, the better. But this trade doesn't work that way. And it's because of the difference in time and the function that the Greeks have on the two options in this trade. Okay, so in essence, what we're showing here is the fact that as you go from an out of the money position, that's the orange. Okay, so this is the put calendar that you would place at strike 28. And you notice that it has a slightly negative delta, again, what we expect. But as our equity falls, okay, in other words, as we start to go closer to the at the money position, as you see here with the strike 30, or even if we were to go into the money with our calendars, the thing that you notice is you get the change, right? You actually go from a slightly negative delta to a flat delta to a positive delta to even a quite positive delta. The strike 33 put calendar, several strikes in the money, has a positive delta to it. You're using puts, but you have a positive delta. Now, some of you may be thinking that's kind of interesting. Could there ever be a scenario or an application where maybe I could use a trade like this, where it actually is in the money for a bullish expectation, where I position in the money because I expect an equity to move somewhat bullishly? The answer is yes. Okay. Back again, it's all about the understanding of how these various places on the chain affect the Greeks, affect the expectation for your trades, okay? But in terms of if we are positioning this trade for the slightly bearish trend and we get too much bearishness, what we show here is why you get this change, why you go from a negative delta to a positive delta. And it has to do with the fact that our shorter term put The change here in this delta is much faster than it is in our longer term put. This is gamma. What you're witnessing is the impact of gamma, changing of delta. I like to say that when you're working with short-term options, 30 days or less, okay, your gamma becomes very, very significant on your trades. And if you're working with weeklies, I call it the Maserati position, right? You've probably all driven multiple cars in your lot, okay? And so, different cars respond differently. They have more or less sensitive accelerators or gas pedals. You take the exact amount, identical amount of force, and you position it on the gas pedal for a Maserati or for a pickup truck or for a 20-year-old Hyundai, right? Those cars are going to respond differently to the exact same amount of pressure on the accelerator. So if you're dealing with weeklies, you're working with a Maserati. And there may be a time and place to do that, but the other thing that can happen is if you don't understand that, okay, you can get into a lot of trouble. You can lose money. That's what this is about, making money or losing money. The understanding of this is very impactful for that, okay? Some of you may want to be in that position, but others of you, that may be a little too hot, right? Stove's a little too hot there. You might want to position differently. And that's why we teach all of the trades that we teach in various scenarios so that you can determine for yourself what makes sense for your portfolio. Tony, great question. What determines your strike price? That's where we take a look at technicals. What is the trend? What is the typical range for our particular equity for a given period of time? In terms of establishing, because the closer we get, the closer the equity gets, I should say, to our shared strike price in this trade, the better our results, as I showed you. So we use that. NPD, Mike, stands for net position delta. And what that refers to, Mike, is the overall delta for this trade, the put calendar as a whole. Okay? Yep. Very good question. Now, let's move on to the diagonal, because this is really interesting. This is what I have right now on the SPY, is a put diagonal, because what we're doing is extremely similar to everything I just showed you, but we are going to make a change, and it's an important change with this trade. What we're doing is we are going to allow for more equity movement, okay? That horizontal calendar is what that's called, where you have that shared strike price. You really do want the stagnant to very slight movement. With this trade, the diagonal, we are going to allow for, even profit from, a greater degree of equity movement in this case. So with this setup, the long option can be placed out of the money, at the money. You could even go in the money with your long option. Okay, the long option chosen should optimize the expected trend, but now we take our short option and place it at a different strike price than the long option. This makes this a more directional trade than what I just showed you with the calendar. So we still get theta benefit, positive theta, okay, with the trade, but we also get to bring in delta and, of course, gamma, the rate of change of delta, as benefits into this trade. Okay, so it's a significant difference between the two. So with our diagonal, it's the same, in essence, the same sort of setup. 3 months or more of time value, but our short call at a different strike price, typically a higher strike price than the long call. It's really interesting when you take a look at the profit and loss graph, because I think you can visually see the difference between the two. Now, forgive me, I am not an instructor at Options Animal because of my drawing skills, okay? Fortunately. This was, in essence, our call calendar, okay? This is our call diagonal profit and loss graph. So the main change comes right here. And the thing that you notice is, this is price at the bottom. This is a trade that can make more money and can also continue to make money for us in a stronger bullish trend scenario. In other words, where we would be at a loss in our calendar, we can actually be at a profit in our diagonal. Okay? So it is a very important difference between the two. So let's look at an example. We've got XYZ at $31.50. So what we're going to do is buy the 132-day strike 32 long call, paying $2.63 per share, sell the 27-day strike 33 short call at the bid of 67 cents, total debit $1.96 per share. Okay. Primary exit is to allow the short call to expire and close our strike 32 call. We could close this at a loss, or of course what we will do is we will adjust it to the new trend. And a stagnant trend, same exact calculations that we went through before. We want to see how it will perform in the stagnant trend first, and then of course take a look at if we get the sort of bullishness that we are looking for. So we theta decay our long call for the 27 days, and you notice that in this scenario, we would be looking at a 16.8% return in 27 days if our equity stayed right where it is. That's pretty fantastic, right? But now let's take it a step further. And let's say that we do get this bullish movement to 33. That's our short call strike. Well, once again, now we get to bring in the benefit of delta and gamma into the trade. And you see that with the $1.50 of gain in the equity itself, we multiply that by the delta per dollar, 0.5250 cents per share, 78 cents. When we add this to the theta decayed long call value, we're now looking at $1.11 of profit for a 56.6% return in 27 days. Now, I probably got your attention about now, right? When you take a look at these sorts of returns. So, this is a version of the trade that can better accommodate the sorts of movements that we're having right now in the marketplace. Maybe you are sitting on directional options where you have some profits, right? And you really believe that Santa's not done, let's say, but at the same time, you're also aware that, we could be days, weeks away from a little bit of a change in the marketplace. There's a lot of really positive sentiment right now that could potentially change depending upon what happens. So is there a way for you to perhaps stay in the trade, but to have some hedge with that? Yes, you can go into this sort of scenario where you turn it into a call diagonal, for example. Okay? This is where, and I love this, because now I don't have to draw it for you, this is where you can compare side by side the difference between the call calendar and the call diagonal. Okay, so with our call calendar, we would be establishing the call calendar at the 33 strike. Okay, so we buy the long call and sell the short call both at 33. Now, in our trade that we just walked through, we bought the 32 long call and sold the 33 short call. And you notice this is where you see the biggest difference right here. This is that net position delta. $12.69 here on the calendar, $18.36 on the diagonal. So it starts off with a more bullish expectation, or you should. The bullishness will provide greater profitability in here. Same expiration for both, Tony. Absolutely. Yes, on this trade. Okay. The other Greeks are different to some extent, but this is where you get the biggest difference. That's why we say we're adding this delta into the trade. Ashwin's got a question, a good one. If the market doesn't follow this expectation, can you change this? Can you go from a calendar to a diagonal to a calendar? Yes, absolutely you can. And those are the sorts of details, Ashwin, that we teach within the curriculum. How do you do that? How do you determine that a trade like this is getting into trouble, right? And we teach all of that kind of management inside the curriculum. So the answer is yes. We can also change it to other trade structures as well if we truly get a very different trend than what we're expecting. Okay. So let's compare two strategies on the same equity. So let me populate this and then we'll kind of walk through it. So exact same equity comparing the call calendar to the call diagonal. Okay, and you'll notice that we've got $64.64 and a penny, and that's because this was live when this slide was being created at the time. So for the calendar, we're buying the June 67.50 call. We're doing that in both trades, same base. But the difference here is the short call that we're selling. Okay, here we're selling the 67.50 that creates the calendar. Here we're selling the strike 70. Okay, in March. So notice first of all which trade is going to have more risk. It's going to be our diagonal. Now, why does the diagonal have more risk? Well, we're selling a further out of the money short call, and when we do that, that short call at 70 doesn't give us as much credit as the call at 67.50. We're paying the same amount for our long call, we're getting different credits for our short call. So your diagonal will have a greater degree of initial risk to it because of that. Okay. Now take a look and you really see very clearly what it is we're doing when we go with the diagonal versus the calendar in the top two Greeks in particular. That's delta and gamma. Okay. The delta for the call calendar, $10.93 at the beginning. The delta for the diagonal, $20.74, twice the beginning positive delta for a greater bullish expectation. The other thing that you notice is gamma. Notice how our gamma here on our diagonal is smaller. Not quite half, but at least 40% below the gamma on the calendar, meaning that not only are we going to get more bang for the buck, so to speak, from the start, but this is a trade, the diagonal is a trade that allows for greater degrees of profitability if our equity continues to be bullish. Okay? You can also see it here when you look at your what we call the spectral slice, right? So those of you, again, who are familiar with this sort of thing and looking at your different trades, of course, we know that red is loss, green is profitability. See the deep dark green? That's where, you're kind of at the sweet spot, right? That's where you're getting close to maximum profitability. Look at the size. The difference in size of those areas between our two trades. The call diagonal has a wider slice for a greater degree of profitability in bullishness. Okay? So there's no right and wrong. It's really about what equity are you utilizing and what is the trend that you have in place at the time that you are considering the trade. Okay? Everything that you do is really about, I tell you what, let me do this. I'm going to do this so that we can just focus on this one thing. Because if I were to try to boil down for you, I ran into, let's start that again. Remember I told you, artist I am not. Okay. If we were to boil down for you what it is that we teach you to do at Options Animal, okay, what are the missing pieces for you? Are you closing 91% of your trades successfully? Would you like to? Because that's what our graduate at Options Animal are able to do. And it comes back to this. We're going to call this the blue nacho of trading. Okay? There are three things that you are working with always when it comes to your trades. And Ashwin, this might even help to answer the question you have about diagonals and calendars, right? So risk, reward, that's the RE, reward and probability. Okay. These are the three metrics of your trades. At best, when you are looking at the various trades that you can place, you will favor you will get, in other words, two of these three metrics in your favor on a trade. There's no free lunch, right, when it comes to trading, so something's going to give a little bit. So, for example, Ashwin's asking about adjusting the strike prices for the diagonal and the calendar to keep risks similar, okay? And there was also a really great question about changing calendars and diagonals to other sorts of trades, and why this trade versus another trade, right? Okay. You can create trades. We teach you how to create trades at Options Animal where these three things, let's just say they're in balance with each other. Okay, where we're really trying to balance the amount of risk that we're taking in a particular trade structure for the reward that we're able to get and the probability of that reward occurring. Okay, so let's say we've got a balance scenario. We can change that. There may be a piece of our trading that we want to do that favors probability. For example, we want trades that have a much higher degree of probable success. Okay? Well, we can teach you how to place those trades. Some of those trades are my favorites, by the way, because I call them my background trades that I place, and they just sit in the background, and I almost never have to make adjustments to them. They just work again and again and again and again. Now, those trades, okay, that favor that probability, for an identical amount of risk I may take, my reward will be smaller. For example, I showed you an example of a diagonal where you have the potential to make 56% in less than a month's time, okay? Some of these trades that I'm mentioning that favor probability, they're not going to get that kind of return in that same time frame. They're going to have a lower return, okay, for the amount of risk I'm taking, but they have a much higher degree of probability of success. Now, some of you may say, I really want to favor reward. I like that 56%, Karen, very much. Okay, great. So what happens here is, for a given amount of risk, you may have lower probability of success on those particular trades. And once again, excuse me, there's no right or wrong. It's really about understanding how to take your portfolio, okay, the amount of capital that you have to utilize, and apportion it across these various trades that have these different metrics for success. Okay. Here's another example in terms of the diagonal as compared to the calendar. The greater debit for the diagonal means greater risk to start in the trade. The greater delta means it's more sensitive to price movement, more potential profitability for a given amount of price movement as well. Gamma is less negative, as I said, so the trade stays bullish for longer and has a higher break-even point. Now, theta is going to be a little bit lower in the diagonal, so it may not benefit as well, or to the same degree, rather, that a calendar will benefit, okay, because of our lower theta. Vega, benefit. Again, why I'm in a SPY diagonal, the trade stands to benefit if there's an increase in implied volatility. So you take this and you choose the strikes to fine-tune your trade expectations. Now, very quickly, the put diagonal obviously is the same scenario. It's just this time we're looking for bearishness, right? And the put diagonal, because we are going to have a short put at a lower strike price, is going to allow for a greater degree of bearish movement. That's what I have on the SPY at present time. So in this particular example, where we choose the strike 30.32 put diagonal, we buy the strike 32, sell the strike 30, $2.48 per share of risk in this particular trade. We would be profitable 9.2% in this example in a stagnant trend, but if we were to fall to 30, okay, where our short put strike sits, we now get the benefit of that delta movement coming into the trade. Okay, we get to increase the value of our long put because of this bearishness. We would now be looking for the potential of a 37.5% profit in 27 days' time. Okay. And here you can, I'm sorry, one too many clicks. You can see visually the difference between the two trades, and once again, the biggest difference is right here in that starting negative delta. In this particular example, almost 3 times as much negative delta. So this is a trade that is going to make more for us in that bearishness than is the calendar. Okay? So the type of diagonal should be chosen with a reflection of the expected trend. Call diagonals for bullishness and put diagonals for bearishness. The short options are normally sold at a strike price that optimizes the trend. Okay, the objective is to lower our cost basis on that long option without our short option being assigned. Now, I will tell you, are there ever exceptions to this? Yes. There's one of my fellow instructors. One of the ways that he likes to get into shares, as opposed to just going out and buying the shares, okay, at market price, one of the ways that he likes to get into shares is to actually create a put diagonal. The way he looks at it is this, okay, he creates a trade where he can be profitable if the equity doesn't fall to the downside. If the equity falls to the downside and it goes through his short put strike, where he's obligated to purchase the shares, okay, he'll take the shares through assignment. He'll keep his credit, by the way. When you do get assigned on shares, you get to keep the credit that you take in, reducing your beginning cost basis. Now he also already has a protective put in place for his shares. It's one of this sort of natural secondary exits, if you will, for a put diagonal if it starts to go into the money. He already has his protective instrument, his insurance policy, further out in time, and he moves forward in this manner. It's his way of creating a discount when he takes the shares as opposed to just paying market price. It's one of several trades that we teach at Options Animal to do that sort of thing. If the structure of the trade presents any sort of additional risk beyond your debit, your broker will require additional risk capital in the trade. We're at our time, and as I mentioned, it was my goal today in the time that we've spent to show you how thorough we are here at Options Animal in what it is that we teach. We want our students to be successful and prepared for any and all market scenarios. The best time to get this knowledge, to be prepared, is of course 20 years ago. The second best time is right now. To that end, as I mentioned, I do have a special offer for you today regarding becoming a member with us here at Options Animal. If what I just shared with you resonates with you on any level, I encourage you to call in. The first 7 callers are going to lock in a special discount on our curriculum, 25% off any membership that you would purchase with us. I just covered in 1 hour with you what would typically take much longer, and at a much slower and more thorough pace to cover within our curriculum. I imagine that you might have questions. We want to answer those questions for you. We want to find out about you. What are your goals? Okay, how long have you been working in the markets? Where is it that you want to go? Do you want to close 91% of your trades successfully? Right? That's what we're doing across 7.5 years at Options Animal, using this thorough methodology that I just shared with you and so much more. In addition to that, if you join us before this Friday, December 16th at midnight, 3 weekly trades for a year. Now, I didn't mention our weekly trade service. Let me just quickly tell you what this is. I mentioned that we're closing our trades at a 91% success rate. Each and every week, we place one new live, I call it skin in the game trade, in the marketplace. This is done by the instructors, and of course I happen to be one of those instructors. We are not a broker, okay? We are not a trade recommendation service. We want to teach you to trade the equities you desire to trade. The purpose of our service is so that students in a real-time fashion can watch, I like to call it peeking over the shoulder of their instructors, watching us as we use everything we teach inside our 8 levels of curriculum to success in the markets. Sometimes, by the way, what those students see are trades, that we need to adjust back to a profitable conclusion. I will tell you, over 60% of these trades go to profit with 0 adjustment being needed. Okay, we actually have right now, there is an open trade that happens to be a call diagonal that is getting ready to close for some phenomenal profitability in the marketplace. Talk about placing the right trade at the right time with that particular example. we utilize all of the different trade structures that we teach within these animal trades. There are times when we do, in fact, need to make adjustments because equities do, in fact, move to a greater or lesser degree than what we're expecting. Students have the opportunity to watch us in real time as we make those adjustments and bring those trades back around to their profit conclusions. Okay, so on behalf of Options Animal, I want to thank you all for your time and attention this afternoon, or perhaps even evening for some of you. Dawn, as always, I want to thank you for inviting us to be part of your TradeStation series. I love the series that you're doing. I think it's phenomenal what you guys do, and it's always a pleasure to work with you as well. So for those of you who might be interested, I'm going to type in my email at Options Animal here in our chat box. If you have any additional questions that you would like to address to me, there it is, Karen S. at optionsanimal.com. We hope you pick up the phone and call. I can tell you, as a graduate, myself, and of course an instructor, what you learn is incredible, okay? And so we look forward to hearing from you. I look forward to working with you as an instructor here at Options Animal. Thank you all so very much.